Hi, it's Arjun. This week, we want to provide our long takes on the outbreak of hostilities between Israel and Iran. Long takes are our attempt to provide long-term perspectives on current events, and we try our best to avoid the hot takes and the sort of quick and instant reactions with the short-term focus. We're trying to avoid that. We are recording this midday U.S. time on Friday, June 13th, in case there are any further developments before this gets published. And I want to make 5 main points. I think the first is, and sorry for being a bit of a broken record on this, but our core macro framework for energy commodities has been and remains super vol as opposed to super cycle or structural bear market or energy transition or net zero. We've never liked any of those other terms. We don't think they've applied since early 2022. Our basic message has been prepare for extremes and do your best to kind of perform through all the ups and downs. Of late, we've had a particular whiplash here in crude markets where we had the Liberation Day tariff trade war sell-off made worse by the kind of surprising faster than expected unwind of OPEC plus cuts that were right on top of the tariff trade war, or the worst part of it, in early April. And that's given way here in June prior to Israel-Iran of sort of a surprising rebound and resilience to crude oil, and now a further spike, at least here Friday as of midday, in crude oil back towards the mid to upper 70s. And I think for corporates and investors, it is about not getting too high during the better times or too low during the worst times. How do you thrive? How do you survive through all the volatility that we think certainly has occurred and we expect to occur going forward? The goal is for companies to generate superior profitability and better per share growth through all those ups and downs. That remains our focus. In trading parlance, it would be buy dips, fade rallies. But again, we're not trying to give trading advice. Our second key message, and we can hear the question now. We get that the recent periods of geopolitical flare-ups, whether it was Russia, Ukraine, or other Middle East situations, had led to a sort of a quick fade in the initial spike. What if this time we do have contagion within the region? What if this is the first step towards a broader conflict and more supply gets disrupted? And I think you all do know our view by now that when it comes to OPEC spare capacity, we think it's generally more limited than what consensus has believed. We peg it at maybe just over 4 million barrels a day. And today, first of all, we are not aware that Iranian supply, again, as of midday Friday New York time, has had any sort of disruption to it. But it's about 3.5 million barrels a day, and the exports are a little over half of that. So if for some reason Iranian exports did go offline, that would eat through a good chunk of the spare capacity. But from this question of contagion, which is really the question, yes, you can always paint a picture where you have broader and more longer-lasting disruptions, but we still struggle to build that in as anything other than a sort of a low probability tail risk. And we are going to harken back to President Trump's recent visit to the region and the speech about commerce over chaos. And separate from whatever President Trump's views or policies are, when we spend time with folks from Saudi Arabia and UAE in particular, as we've written about, we think these are really important countries going forward, that some of the modernization efforts they've taken, some of the steps by their state companies, they're going to be at the center of meeting the world's energy needs, not just from oil, but from other sources of energy. And I do think this theme of sort of commerce over chaos, it may seem odd to raise that, as Israel had dropped bombs in Iran, and we're going to see what the retaliation, if any, is. I'm going to say that we should not look at the region like it's the 1970s. We should not look at Saudi Arabia and UAE specifically as if it's still 20, 30, or 40 years ago. And we'll see if that view plays out. But at least for us, it keeps us from having a sort of gut reaction that when there's Middle East turmoil, somehow we should always think it's just a structural bull market is the next thing to happen. We don't fall into that camp. And as a reminder, within the region, your most important producers are Saudi and UAE, where I think we feel that the commerce over chaos sort of tagline most applies to it. After Saudi and UAE, would say Iraq and then Iran in sort of order of importance. I think the third key message we want to deliver, and this one I know is going to get some pushback, is that perhaps Saudi and maybe UAE deserves the credit as well in OPEC research. Maybe they're all smarter than what we give credit for. So even myself, when we first heard about the post-Liberation Day extra oil coming back on the market faster than expected, we called it pump for Trump. And I'd still say, I think that is a more reasonable explanation, or was at the time, than this idea that somehow Saudi and UAE are mad at Kazakhstan for letting Chevron bring on the Tengiz expansion project. We find that to just be a silly, frankly, laughable reason for why suddenly, after 4.5 years of supply discipline, now we're mad at Kazakhstan for bringing on this project. Have not believed that. But we did still call it pump for Trump, as if it was important for those countries to do that. And I think you do have to wonder that if you take a step back, prior to Israel-Iran from the last day and a half, we were seeing better than expected oil demand in the face of what was generally a lot of recession concerns. We're going into the seasonally stronger period anyway, both in terms of US gasoline as well as the Middle East air conditioning season, where you have several million barrels a day of sequential demand increase, well in excess of the extra oil that, again, surprisingly came back onto the market more quickly. And perhaps as notably, we've seen some meaningful upward revisions to historic global oil demand. This is from the IEA and others that suggest the market had been tighter all along. And I think, we want to give a shout out to OPEC research. When you look at these major agency forecasting bodies for oil supply demand, OPEC research has gotten a lot of criticism for being too optimistic on oil demand. And while their numbers are still higher than some of the other key bodies, the market is coming their way to a greater degree, and I think they deserve some recognition. So the fact that Saudi, UAE, others have sort of proactively and maybe even preemptively decided to bring back some of their spare capacity, again, in the face of better than expected demand, sequential increases, stronger historic demand than everyone else had realized. And now perhaps with the hedge of they didn't know what was going to happen between Israel and Iran, I think for all those reasons, you might say Saudi's done actually an okay, Saudi, UAE, and OPEC research have maybe done an okay job managing through it. And I think I'm going to give them a shout out, and they are deserving of probably more respect than they've gotten. The fourth point we want to make is that when it comes to structural paradigms for oil markets and geopolitical turmoil, it is the health of global economic growth and oil demand that we're going to say matters most. And we're going to give you 3 examples here. We've written about this, I think, early in Super-Spiked. I'll try and see if I can find those posts and maybe tag them here. But the first is, if you look at the Iran-Iraq war from 1980 to 1988, I want to say between Iran and Iraq, you lost 6 million barrels a day of oil. And of course, that ended up being a very bearish period at the end of the 1970s super cycle, that disruption, as significant as it was, oil markets were much smaller then. Maybe they were 60, 65 million barrels a day. So such a disruption was a very material amount. And it turned out to be a very bearish period for oil demand and oil prices over that period. The second was Gulf War I in the early 90s, short-term spike, not dissimilar from Russia, Ukraine. And at a period of sort of lackluster conditions, oil frankly went sideways. And that disruption also turned out to not really matter. And then you have Gulf War II in the early 2000s. Now, I don't think anyone at this point attributes oil going from 20 to 100 to Gulf War II. But we'd note that disruption did happen at a time where non-OPEC supply was disappointing, OPEC spare capacity. People finally realized it's more limited than people thought. And of course, you had China, BRICS, and that economic expansion and really kind of booming global GDP growth. And so there you had a super cycle. Again, I'd say is driven by demand for oil over and above everything else at a time that supply was finding a tough time to come on. And we're not, I don't think we're in sort of the 1980s period where demand's going to decline. Maybe it's sort of, something more like the 1990s, but with a little more volatility. The point is simply, it is the outlook for global economic health and oil demand that I think matters more than Middle East turmoil, if you will. I think the fifth and final point we want to make is really around oil equities and how to think about them. And our focus has been and remains, which are the companies that through all the ups and downs, whether in a bull market, bear market, at the high, at the lows, what have you, who is going to generate superior profitability, which we will define as mid-teens, cash on cash, or even ROC returns over a full cycle, superior per share growth. Combination of these two things is the best combination. Who's going to be able to deliver that over time? And in that context, from a broader perspective, oil equities are currently at the lower end of their S&P weighting. So while it is true, and I know some people are going to say, hey, you don't sound sufficiently bullish for all this quote news about, Israel and Iran. And our point again is what drives oil equities? Returns and per share growth through a cycle. And then what drives structural bull markets? We're going to care most when structural oil demand is growing decently in excess of non-OPEC supply. And we don't really have that ladder. Again, it's why we've resisted the super cycle language. I think we otherwise would feel good about oil equities, that we are still generally closer to the low end of that S&P range. Now, some people say, hey, this is proof that oil equities should be portfolio insurance. Is that right? Is a generalist portfolio manager going to own, if it was a struggling sector, just because occasionally there's some price spikes that fade? To me, it's not a core driver of oil equities. The way I'd phrase it is, if you have a company that can compete for general investor interest, better returns, better per share growth, then you can see, I don't know if it's a half a multiple or a multiple point turn, as being the oil or energy stock they want to own, perhaps this portfolio insurance risk. So it is like the third or fourth reason that might help the multiple a little bit. It's not going to be the core driver. And I think it's an important distinction. It's why we don't get too carried away when we have these kind of turmoil type situations. So I'd like to end this video on a personal note. And of course, this video is being published on June 14th, the day before Father's Day. I would like to wish all the fathers a happy Father's Day. My parents, as I've noted, they're 85 years old. They're at a point in time where they need to live closer to us. So my Father's Day gift is both parents are going to be moving in with us for a couple months till they get their own place much closer to us than where they've been. And we are excited about that as well. It is a time of geopolitical turmoil in the Middle East. And while the current conflict is between Israel and Iran, there certainly are U.S. military men and women serving around the world, including in this region, many of whom are going to be dads, or many of whose dads are serving. And we want to give a special shout out and thank you, and our prayers and wishes for all those folks to be safe on Father's Day. Thank you.